Good evening, everyone. It's Sesa Osasuzogi, and today I'll be talking about the stock market, along with other digital investment options you can look into at your own time. Let's get started. First off, what is a stock? A stock represents a unit of fractional ownership in a corporation. In simple terms, this is a part of a company that one owns. Now, how do they even function? Look at it like this. It's like buying a tiny slice of a gigantic pie. So the whole pie Apple owns. This little sliver of pie you own. Here are some terms you need to know about how stocks function. Ownership and value. When you buy a share of a company, you become a shareholder. When the company does well, the price of the stock increases and you gain money. Dividends. This is the payment made to a shareholder from the company, specifically from their profit. Supply and demand. There are supply and demand zones. Areas in a stock where buying interest is high, demand increases, and areas in a stock where selling interest is high, supply increases. Initial public offering. This is the process where a private company first sells shares to the public. This is to raise capital for later expansion. Capital appreciation. This is when you sell a stock for a higher price than that of which you bought it. This process occurs later, usually when demand increases. Now, you need to know that there are many kinds of stocks. Here are 4 common ones that I researched on. Common stock, preferred stock, growth stock, and income stock. First, let's talk about the common stock. This type of stock provides voting rights, but higher risk. In simpler terms, this stock is designed for long-term growth, but the company's condition determines how it grows. Risks of losing money are high if good conditions aren't met. Preferred stock. Generally, there are no voting rights, but higher priority for dividends and assets during bankruptcy. In simpler terms, shareholders with these kinds of stocks are paid with more favor than others, even if the company goes bankrupt. Growth stock. Companies expected to grow rapidly, but usually with no dividends. In simpler terms, this stock grows the most rapidly. If good conditions aren't met, the risk of losing money is high, just like in a common stock. Lastly, there's income stock. Mature companies that pay steady dividends. In simpler terms, stockholders are paid in consistent cash. Risks of losing money is very low and is considered the best choice for those who are conservative. You don't just buy a stock and expect to earn money every time. There's what is called risk factors. A risk factor is exposure that explains the volatility and return profile of an asset, indicating the probability of losing money. In simpler terms, a characteristic or change in a business condition that causes the price of that stock to either rise or decline. And here are risks to look out for: market volatility, liquidation risk, and emotional investing. Let's look into it. First, market volatility. The prices of stocks can change rapidly depending on the effect, economic news, political events, or company performance. Liquidation risk. If a company goes bankrupt, the last people who will be paid are the shareholders, so this is a big risk for investors. And emotional investing. This is the dangerous practice of making financial decisions based on your emotions, mainly fear or greed. Depending on how big a company is, it will belong in a certain market capitalization category. Here are the certain types of sizes. Mega cap, which is $200 billion or greater. Large cap, which is $10 billion to $200 billion, mid cap, which is $2 billion to $10 billion, small cap, $300 million to $2 billion, micro cap, which is below $300 million, and nano cap, which is below $50 million. Now that we have all this information, how do we start? Consider these 4 steps. First, open up a brokerage account. Second, research companies. Third, diversify. And fourth, consider index funds. Opening up a brokerage account. This is when you open up a specific account for stock trading. This is typically a short 15-minute process. Researching companies. You should research specific things like the company's financial health, its business model and industry, management team, key financial metrics, and valuation ratios. You should find out more about different types of companies. Diversify. Don't put all your investment money into one single stock, but use it to buy from multiple industries to reduce risk. And considering index funds. This option allows instant diversification by tracking one single index. Here are indexes to consider: S&P 500, This tracks large cap US businesses. And Russell 2000. This tracks small cap US businesses and is ideal for high potential. Before you start becoming nervous, thinking different thoughts, here are some last notes of encouragement. Investing is a marathon. Make sure to focus on long-term growth rather than short-term growth, which isn't very effective. Be patient and don't let your fear or greed drive your decisions. Oh, and before I forget, here are other options you can consider to start your investing journey other than just stocks. There's cryptocurrency, digital real estate investment, and commodities, and there's even more. Before we end this presentation, let's go over real quick some vocabulary words that you've seen, but you probably don't know about. Profit. This is financial gain realized when a business's total revenue exceeds its total expenses, representing the surplus funds remaining after all costs. Capital. The financial resources, assets, and funds such as cash, equity, and debt that businesses use to fund operations, purchase assets, and drive growth. This represents the accumulated wealth used to generate more income for employees. Voting rights. The entitlement granted to shareholders, usually owners of common stock, to vote on key corporate governance matters, such as electing board members, approving mergers, or changing bylaws. Assets. A resource owned or controlled by an individual, company, or government that holds monetary value and is expected to provide future economic benefits. Conservative. This is an investment approach focused on capital preservation, aiming to minimize risk and prevent losses. Volatility. This measures the rate and magnitude of price fluctuations for a security, acting as a key indicator of risk and market uncertainty. Return profile. This defines an investment's anticipated performance, combining expected gains with associated risks over a specific time frame. Business model and industry. This is the company's blueprint for creating, delivering, and capturing value to generate profit, outlining its product, target market, and expenses. Key financial metrics. This is essential measurable values used to assess a company's profitability, liquidity, efficiency, and overall health. Valuation ratios. Financial metrics that compare a company's stock price to key financial data, such as earnings, sales, or book value, to determine if a stock is overvalued or undervalued. Index, a statistical measure, a hypothetical portfolio that tracks the performance of a specific group of assets, such as stocks or bonds. Thank you for listening to this presentation. I hope you've learned a few things about the stock market. Thank you once again.
Yeah.